Imagine waking up on January 1st, 2026. You have $0 in assets. No stocks, no bonds, maybe just a little debt and a job that pays the bills, but not much else.
The financial headlines are screaming about interest rates, AI taking jobs, and housing prices that look like phone numbers. Most people freeze right here. They assume the game is rigged, so they don't even pick up the controller.
But if I had to start from absolute zero right now, knowing what I know about compounding, market cycles, and human psychology, I wouldn't panic.
In fact, I would argue that 2026 presents a cleaner entry point than we have seen in a decade, provided you ignore the noise.
The strategy I am about to lay out isn't about getting rich by Tuesday. It is the mathematical path to your first 100,000 and eventually...
It starts with a number that most people are terrified to look at. Before we open the spreadsheet, I need to make a deal with you.
I'm going to break this down into 4 specific phases: the foundation, the engine, the portfolio, and the tax shield.
This is a complete roadmap. I'm not selling a course at the end of this. The only cost of admission is your attention. If you want to treat this channel like a peer review session for your finances, go ahead and subscribe. I aim to give you the highest return on investment on your time on YouTube.
Now, if I am starting at zero, the first thing I have to address isn't which stock to buy. It is the invisible anchor dragging me backward. I call this the negative compounding trap, and it is usually disguised as a monthly payment.
There is a pervasive myth that you can out-invest your bad habits. I see people all the time asking if they should put money into a crypto coin or a tech ETF while they are sitting on credit card debt. They think, well, if the market does 10% and my debt is 20%, I can just catch up later. This is the financial equivalent of trying to fill a bucket that has no bottom.
If I'm starting fresh, I have to accept that my net worth isn't zero. It is negative. And until I fix that, the stock market is off limits. It sounds harsh, but mathematically, paying off a 20% credit card is a guaranteed 20% return.
You cannot find that in the stock market without taking risks that could wipe you out. Say you have $5,000 in consumer debt at 24% interest. A pure, distinct voiceover narration provides context. If you make only the minimum payments, you will end up paying back nearly double that amount over the next decade.
Meanwhile, if you took that same monthly payment and invested it, sure, you might make some gains, but the interest drag is literally eating your future. In 2026, with interest rates likely stabilizing but not returning to zero, the cost of borrowing is real.
Every dollar of interest you pay is a dollar that isn't compounding for you.
My strategy at zero is aggressive. I'm not an investor yet. I am a debt destroyer. The math dictates that I must clear the decks before I try to build the house. Here is the twist that catches people. We keep debt around because it feels manageable. It is just a monthly line item, like Netflix or the water bill. We normalize it.
But psychologically, debt creates a scarcity mindset. When you owe money, you are afraid to take career risks.
You are afraid to ask for a raise because you can't afford to lose the job. You are afraid to move cities for a better opportunity. The true cost of that debt isn't just the 24% interest. It is the opportunity cost of the life you are too scared to live because you are shackled to a bank. Clearing this isn't just a financial move. It is a psychological unlock that allows you to play offense later.
So, the protocol for phase 1 is simple.
I list every single liability from highest interest rate to lowest.
I ignore the balance size, I only care about the rate. This is the Avalanche method.
I throw every spare dollar at the highest rate debt while paying minimums on the rest.
I sell things I don't need. I downgrade subscriptions. I treat this like a hair-on-fire emergency.
Once that high-interest debt is gone, I don't celebrate by buying a watch.
I take that entire monthly payment amount and I get ready to pivot.
But wait, before we put that money into the market, there is a massive trap that 90% of new investors fall into. You might think, okay, debts are paid, time to buy the S&P 500.
If you do that, you are statistically likely to fail within 18 months. Why? Because life happens. The car breaks down. You need a root canal. If your money is tied up in stocks and the market is down when your car breaks, you have to sell at a loss to fix the car.
You just locked in a loss and destroyed your compounding. We need a buffer.
The common belief is that cash is trash. Influencers will tell you that inflation is eroding your cash, so you need to be fully invested at all times. While inflation is a concern, cash serves a different function in the early stages. It isn't an investment, it is insurance. If I am starting in 2026, I am building a cash fortress before I buy a single share of stock.
This is my sleep well at night fund. It needs to be liquid and it needs to be boring.
People hate this part because it feels like you aren't making progress. You see the number in the savings account, and it doesn't move much.
It feels stagnant. But that stagnation is actually stability.
Let's look at the math of having a buffer versus not having one. Imagine two investors. Investor A puts everything into the market. Investor B keeps $10,000 in a high-yield savings account earning 4%.
The market corrects by 20%, which happens on average every few years.
Then, both investors lose their jobs. Investor A has to sell their stocks at the bottom of the market to buy groceries, locking in that 20% loss permanently.
Investor B uses the cash buffer, leaves their portfolio untouched, and waits for the recovery. By the time the market bounces back, Investor A is broke and Investor B is whole. The math favors the person who never has to sell at the wrong time.
There is a deeper psychological layer here. When you have 3 to 6 months of expenses sitting in a bank account, you walk differently. You negotiate differently at work. You aren't desperate. This prevents you from making emotional financial decisions.
Most bad investing comes from panic, selling when things are red or buying when things are green because of FOMO.
A cash buffer creates a physiological gap between stimulus and response. It allows you to look at a market crash and see a sale rather than a catastrophe.
Without this buffer, you are trading with your emotions, and the market will absolutely bankrupt you for that.
The protocol here is non-negotiable. I am calculating my bare-bones survival number.
Rent, food, utilities, minimum transport. I multiply that by 3. That is the target.
I put this money in a high-yield savings account or a money market fund.
In 2026, these tools are easy to access. I automate to transfer every payday until this bucket is full.
Once it is full, I pretend it doesn't exist. It is not for vacations. It is not for a new phone. It is for survival. Only when this bucket is overflowing do I look at the stock market.
And this is where things get interesting. Because conventional wisdom says to diversify.
But I am going to tell you to focus. The allure of stock picking is strong.
We all want to find the next Nvidia or Amazon before it pops. If I'm starting in 2026, the temptation to use AI tools to pick stocks will be everywhere. Apps will promise you AI-driven alpha. But here is the reality. Finding a winning needle in the haystack is incredibly difficult. For a retail investor with a day job, it is nearly impossible to do consistently. The myth is that you need to be smart enough to pick the winners. The reality is that you just need to be smart enough not to pick the losers. Let's look at the SPIVA Scorecards, the data that tracks how active fund managers perform against the S&P 500. Over a 15-year period, more than 90% of active managers fail to beat the index. These are people paid millions to do this. If they can't do it, the odds of me doing it in my spare time are statistically zero. If I buy the entire haystack, the total stock market index, I'm guaranteed to get the market return. Historically, that is around 10% roughly before inflation. If I try to pick stocks, the distribution of outcomes widens massively. I might make 30% or I might lose 50%. In the early stages of wealth building, reliability beats lottery tickets. The math says, be average, because average in the stock market makes you rich. The problem with index investing isn't that it doesn't work. The problem is that it is incredibly boring. It provides zero dopamine. You buy a fund like VTI or VOO, and nothing happens. No exciting earnings calls, no rocket ship emojis. Psychologically, we crave action. We want to feel like we are doing something to earn our wealth. This is why people trade options or day trade. They are paying fees and taking risks just to feel involved. If I am starting my strategy in 2026, I have to hack my own brain. I need to accept that good investing should feel like watching paint dry. If it is exciting, I am probably gambling. Here is the protocol, the core satellite approach. I put 90% of my investable cash into low-cost, broad-market index funds. This is likely a mix of total US market and some international exposure. This is the core. It is automated, I never touch it. Then I take the remaining 10% and strictly, and only 10%. And I allow myself to be stupid with it. This is the satellite. If I want to buy a specific tech stock or crypto, I do it here. If it goes to zero, my financial life is fine. If it goes to the moon, great. This scratches the itch to gamble without blowing up the plan. But where do I put this money? This is the next leak in the pipe. You can pick the perfect funds, automate your savings, and still lose 30% of your wealth. How? Taxes. If you are doing all of this in a standard brokerage account, you are volunteering to give the government a massive slice of your pie. Most people focus on the returns, but they ignore the net result. We need to talk about location, not where you live, but where your money lives. There is a belief that you should just open an app, link your bank, and start buying. That usually lands you in a taxable brokerage account. While these accounts are flexible, you can withdraw anytime. They offer zero tax shelter. Every time you sell for a profit, you pay capital gains tax. Every dividend you receive, you get taxed. Over 30 years, that tax drag is enormous. If I am starting in 2026, I am looking at the tax code as a rulebook for wealth. The government gives us specific incentives to save for retirement, and ignoring them is expensive. I need to fill the tax advantage buckets first. Step 1. 401k up to the employer match. This is free money. Step 2. Max out a Roth IRA. In 2026, the contribution limits will likely be higher, so check the current cap. This is tax-free growth. Step 3. If you have a high-deductible health plan, max out the HSA. It is triple tax advantaged. Step 4. Go back to the 401k and fill it up. Only after all those buckets are full do I put a single cent into a taxable brokerage account. This order of operations creates a tax shield that accelerates your compounding significantly. But there is one final piece of the puzzle: the income.
We have covered saving, investing, and taxes, but you can only cut your expenses so much. You can only optimize your taxes so far. There is a hard floor on spending, but there is no ceiling on earning.
If you really want to accelerate this timeline, the spreadsheet won't save you. You need to look in the mirror. We are told that if we just stop buying lattes, we will be rich. This is the latte effect myth.
Sure, wasteful spending is bad, but you cannot budget your way to wealth on a $30,000 salary in 2026.
Inflation makes the cost of living a moving target. If I focus 100% of my energy on clipping coupons, I am playing a defensive game.
Only Alex speaks. Defense prevents you from losing, but offense is how you win. My strategy requires me to shift my mindset.
Consider the math of a side hustle versus a career pivot. Driving for a rideshare app might net you $20 an hour after expenses.
It is linear income. You stop driving, you stop getting paid. But learning a high-leverage skill like data analysis, sales, or that salary bump counts for 401k matches, Social Security credits, and future raises. A 10% raise on a $50,000 salary is worth far more over a lifetime than a weekend gig. The math says to invest in your primary income engine first. The psychology here is tricky because learning new things is hard. It is easier to drive a car for cash than it is to take a certification course at night. We gravitate toward low-friction income.
But low friction means low barrier to entry, which means low pay. If I am starting at zero, I have to embrace the discomfort of being a beginner again. I have to be willing to look stupid while I learn a new trade or skill. The comfort zone is where your financial dreams go to die.
So here's the final protocol, the skill audit. I look at my current job and ask, what is the one skill that, if I mastered it, would make me undeniable? Maybe it is public speaking, maybe it is project management software. I dedicate 1 hour a day, the time I would have spent scrolling TikTok, to mastering that skill. I use free resources online. In 6 months, I use that new leverage to ask for a raise or apply for a higher tier role. A 20% savings rate on $100,000 is a lot more powerful than on $50,000. This isn't just theory, it's a blueprint for action. Start today by identifying your highest interest debt and making that first payment. Don't wait for tomorrow. Your financial freedom begins with these deliberate steps. Embrace the journey, stay disciplined, and watch your wealth grow.